Let's give a sec just to get things going here. Make sure we're... All right. Welcome back. Just give it a sec to get things going here, but I think we're live. I came on here. It's 9 o'clock in the morning on Thursday, and this is just going to be a little earnings discussion about current positions in Squarespace blockchain and thoughts going into earnings. Now, I have a position on right now, which is essentially a calendar. It's like two calendar spreads, one at the 85 strike and one at the 90 strike. If we look at, you can look right behind me at the screen there. If I sort of move over slightly here, here's the chart. We had a big run up yesterday, and essentially, if we look at my deltas here, I don't know why this all reset, but let's go to the Analyze tab, and you can see my delta. I'm totally flat. It's showing short 1 delta here. I'm going to get out of the way so you can see better. But short 1 delta here, but you see this massive amount of decay here, 1,400 a day, and this chart. And here's my position. Let's pull it up. Like I said, I've got the calendars on. And essentially, what we're saying here is the position is saying that we're not going to move on earnings, or we're going to move less than the option screens are expecting. So if we look at, let's see if I can clean this up a little bit here, but if we go back to that risk profile and pull this down here, we can see this is sort of the a visual representation of the position here. So if we pull this down, you can see, all right, so between 75 and 100, we're making money, right? And this is set on the wrong day. So let's move this to today, which is the 4th. So you can see this blue line is essentially on Friday expiration, if things end up at these prices, how much money we make or lose. And the purple line is today. So you can see today we stay between, say, between somewhere around like 82 and 94 were positive money. But you can see this line here for Friday is, that's $5,000 right there. So if we don't move at all, this is showing us making $5,000. Now, the caveat here is, once again, as we were looking at before, and if I pull up my Greeks here, you can see it's showing decay of 3,000 a day, right? And what's essentially happened is that these options haven't decayed at all the whole week. So if we look at options implied volatility here, we're going to see these stratospheric numbers. And implied volatility in the front month is going to be like over 200 here. You're seeing these numbers like 214, whatnot. And it's the same, the straddle is the same price. The options are the same price they were yesterday, but it's just as time goes by, that represents a higher and higher implied volatility as we get closer to expiration. And you keep seeing these huge numbers of like decay here, like 3,000. Yesterday it was like 1,000, and it keeps getting higher and higher, because what's happening is like nothing is really decaying. They're just keeping the option prices the same until earnings come out. So even though it said yesterday, you're going to collect this much in decay, we collected a little bit in decay, but it was way less than these numbers, because stuff essentially is not decaying. It's locked in place until earnings come out, and that's fairly typical for a stock coming into earnings. What's unique in this situation is when we look at the chart here, we can see, well, we had a huge run up yesterday, and some people are saying that's due to positive moves in stocks like PayPal and Sophie, which are kind of in the same industry. And the stock's had a huge run up. It was down to 58 or something a couple weeks ago, and now it's back up to, it's heading back towards 100. There's a chart for a while, and you can see from that chart, it's not unreasonable that we could get back to 100 or 150 in pretty short order. And So the point I wanted to make, though, like I was saying before, was that when we see this chart here and shows, oh, we can make $5,000, that's not counting the fact that this Vega number here, that volatility is going to go down in the back month. So we can expect this. You lose $100 for each point volatility goes down overall. Now, this is saying overall for the position, but essentially what that means is because the back month options have a lot higher Vega associated per option, this positive Vega number is due to the options that I'm long in the back month. So what those options are this, the SEP 85 puts. That's most of it, right? And if we go to the SEP 85 puts on the screen here, and we look at the implied volatility of these, we see it's somewhere around an 80, right? Somewhere around 80 implied volatility. And these could certainly come down 5 or 10 points. Now, if these come down 10 points, then this is no longer 5,000. It's 5,000 minus 100 Vega times 10 points, 1,000. So it goes down to possible making only 4,000. And then when you get to like the outside limits here of where like, okay, break even $100, we're gonna have to move these break evens in a bit, because subtract $1,000 from this, because it's certainly, we know that volatility is going to come in. We don't know how much. I'm using 10 points as a guesstimate here, right? So vol comes in 10 points in the back months, we're going to lose $1,000 on the vol crush, which is not reflected in this chart here. All right, so I've made that point. Let's move on. This has had a huge run up here, and so does that mean that that if earnings are okay, that it's going to have even just a bigger run up that's twice as big as this after earnings? Or does it mean that, well, it's already kind of had the run up, and no matter what earnings are, it's probably going to either do nothing or go back down? Well, I don't know. Nobody knows. That's the big question here. And when you look at this account, which this particular account only has about $5,000 in it, well, the chances of making $5,000 on $5,000 is a pretty cool chance. However, we can see that as you know, if the stock does start to make a big move either way, we're going to lose more and more money. So let's model this. Let's look at doomsday scenarios, because that's what we need to do anytime we're taking risks. We want to know what's going to happen in the worst case, right? So if we start messing with these numbers here, all right, 10% move, you can see here, 10% move showing losing $600. However, we're going to still collect this theta, so it's still going to be positive, most likely. We're going to make money in a 10% move because this theta is going to come in. But then if you go to a 20% move, all of a sudden it's showing losing $2,000 in a day, and the theta up there is only $300. So maybe you are losing $1,000 on this position if it's up 22%. Now, let's go up to like 50%. All right, 50%. All of a sudden, whoa, now we've lost $4,000, right? And theta's nothing up here. So you lost $4,000 of a $5,000 account. So up 50%, and we're pretty much almost wiped out. Now, nothing is going to make this account go negative, right? Because we own these calendars. So the most we can lose is what we paid for them. But essentially all the money for the account is tied up in these calendars. So we could lose the whole account if things go bad for us, if it goes up 50%. Let's look down 50%. All of a sudden down 50%, same thing, not looking good, right? It's even looking worse, actually. Look, you lose the entire account, down 43%. So not great. And that would represent stock going to 50. Now, is it likely stock goes to 50? No, but it could happen, right? So how do we fix this? Do we just take the position off? Now, maybe some of this decay, it's showing $3,000 today in decay, maybe they're sellers right before earnings come out, and $1,000 comes in of this decay. Well, maybe we say, oh, we made $1,000, take the position off before earnings and don't worry about it, right? That's one possibility. Another possibility is we could what we could do is called buying our wings in. So we could buy some protection out here in the extremity. So how would we do that? Well, we could do some sort of condor here. So let's say, when we go back to this visual chart, look, it gets bad below like 70 or above 110. So we could do something like buy the 70-80 put spread and the 110-120 call spread, right? So let's model doing that. So we go to the front month here. So we're going to buy the 70 put and sell the 60 put. And on top of that, we're going to buy the 110 call. And we're going to sell the 120 call. So that package is going to cost us 3 points. And the most we could make is 10 points, right? So you're paying a third of that. The other thing is we could move this out a little bit further, right? So instead of 70-60, we go like 60-50. So we make this one. So we move out farther. It costs us less. It's a little less protection, but it's much cheaper. So, and then instead of 110, 120, we go 120, 130. Right, and if we buy one of these, it costs us $100. If we buy 10 of these, it costs us $1,500. Let's see what happens to our position if we buy 10 of these. So all of a sudden, down 43%, we're only losing $400, right? Look at these numbers. I mean, it's like all of a sudden we still have this possible theta here, right in the middle, but doomsday scenario, and we're only losing a little bit. But the problem here is like in the middle here is where this is like if it goes way down, we make back some of it, or if it goes way up, we make back some of it. But if it only moves like to this little sweet spot in the middle here, then we're losing the maximum amount. So up or down 25, 30%. It shows us sort of losing money here. However, so the question is, do we just let it ride, or do we buy some of this protection? Maybe we buy a little bit of protection, right? Maybe we do something like buy. Let's that's saved in our analyze, but let's say maybe we just buy. What would happen if we were to just do something like I think I messed that up. I think I was doing SEP when I should be doing probably be doing August. So we can't really model these August options because they just got listed, but we could do something like the August 98 102 just to look at it, and then the 70-60. What I was looking at was buying wings farther out in the actual the SEP options we were long, which is another possibility as well. And that didn't look bad. That looked pretty good. But here, it's actually cheaper in the front month. Let's see if we do this front month 10 times, how that looks. So that's what I meant to be doing the first time. And let's go in our analyze and make sure that we don't have both spreads in here. So turn that one off. All right, so here is if we buy 10 of these spreads. Now this is what will cost us $1,000, and all of a sudden we look much better for a down move of 20%. Let's take a look at a down move of like 50% here. And we're actually making money in a down move of 50%, and an up move of 50%. We're still losing money. We're still losing $1,000 for a 50% up move. But I mean, just this would cost $1,000, and it makes our position a lot safer, right? Now our theta, if we don't move at all, instead of making, let's look at this under the risk profile. So if we don't move at all, looks funky, doesn't it? The big risk is right at 70, right? So if we don't move at all, we're losing money right at if it goes to 70. No, why is that? Because we're buying the 70 put. So we have no protection until we get to 70. But remember, this curve is going to be smoothed out a little bit, because even on Friday morning, there's still going to be some play left. This is like on actual expiration, but this was going to be smoothed out on the morning of Friday. Anyway, so you see here, this is with adding the $1,000 spread. The risk right there seems to be right at the 70 strike, but you're actually you start making money again to the upside, which I like. Versus, let's take that out of play here, versus this, where you know, if we go down 50%, we're really getting killed here. So it seems like this wouldn't be a bad, it seems like a decent risk reward to buy some wings here if we're going to leave this position on, just to protect us against the worst case scenario. Because, and my concern here really is to the upside of this really ripping to the upside. I'm not as concerned to the downside. It certainly could go to 70 though. So let's see if we can pick a better put than the set. Let's try the 75 60 put spread. Now that looks better, right? Because then all of a sudden, how about 75 65? 75. That looks better to me than the 70 put. And we still, you know, we're still doing pretty good if it rips to the upside. Now, I don't anticipate it really ripping to the upside, but if it does here, we're still doing okay. We might even want to go like, instead of 98, go like 90. And then it's showing us, the thing is that costs a lot more, right? That's $3. So that's taking away most of our theta to bet. This would be really a very bullish bet. Let's chop this down a little bit. So something like that. All right. So we're still collecting decay, but we're spending 2,400 to have this bullish position. So this is really a bet that this stock's going to move higher. So seems a bit aggressive. What if we just did, if we bought 5 of these spreads? Now, you can just see how the risk reward is moving around here. And I kind of like that because, you know, my best guess is this is up a couple bucks tomorrow. But how, nobody knows. So this is where we are right now, and we'll see what we'll see today. Probably what I'm going to do is just wait it out, see if some of this comes in today, and if it doesn't, either maybe buy some of these spreads to protect us from the worst case scenario, or just let it ride. So those are the two options here. And we'll have to wait and see what actually ends up panning out. So that's what I'm looking at. We had position in, I just straight out bought Roku, and it was like the stock that was down the most last Friday. It was 60, and I just sort of closed my eyes and bought it, and it got all the way up to, now it's 78, but I think I sold it at like 75 yesterday. It was still, you know, if I'd held on, I would have made more, but still a great trade. It worked out. You know, I'm out of that now. And especially in this environment, to me, especially in this environment where like everything's come way off the highs, or a lot of stocks have, if you get a stock that's really getting hammered, it might be a good scoopable spot here. You know what I mean? More so than when we're at the all-time highs and stuff might just not come back as much. But stuff seems, the market was really strong yesterday, and everything that's gotten hammered has been sort of bouncing a little bit. Even like my arch enemy GameStop has really had a pretty big move up to the point where I'm looking to once again maybe short it at some point. Let's look at GameStop really quickly here, and I'll let you go. Now, this, I think it's just a piece of garbage company. I think it's up in sympathy with AMC, which has been rallying, and this is, it's had a pretty big rally. It's post split, and so it doesn't. These numbers don't sound that impressive because it's like post split, but it is. If this gets back to 40, that would be pretty impressive. And it's had several up days in a row, seemingly on not a whole lot. I mean, they're starting this NFT thing, NFT marketplace, but where are NFTs going? It seems to me they're going nowhere. Anyways, that's just like my opinion, man, and maybe I'm wrong. Anyway, I'm gonna let you go. Video's running long enough. Thanks for supporting me. Do all that liking, subscribing, support me on Patreon, and I'll see you in the next one. Thank you for those channel members who have been there with me all the time. I love you guys, and